So interest rates are up to 0.75%. Inflation is up massively. We've had the Chancellor's spring financial statement. What does all this mean for property prices? In this video, I'll be trying to put it all together and give you some information. So stay tuned. So if you're here for the first time, make sure you subscribe and hit the bell icon. We put out new videos each and every week dedicated to keeping you on top of your property investing game. Smash that like button as well. A lot has been happening recently. We've just had the Chancellor's spring statement today. Not much there, but I'll be highlighting a few of the points. Last week we had interest rates go up to 0.75%. We've had the latest inflation figures, which, as I predicted more than a year ago, are going to be sky high. But what does all this mean for property prices? Are we looking at a slump? Are we looking at a boom? Are we looking at stagnation? What's going on here? So let's start by looking at interest rates. Well, interest rates have gone up. Now, let's bear in mind that they were at record lows before COVID. Then during the COVID crisis, they were slashed all the way down to 0.1%. Yes, we've had 3 successive rises on the trot, and now they stand at 0.75%, which is exactly what the rate of interest was before COVID. The economy is not doing too badly by and large and is pretty much back to pre-COVID levels. But there are some things that are quite different from pre-COVID times. First of all, it's inflation. Inflation has been rampant. We just had a report out today, 6.2% is the headline rate. Even the Bank of England reckons that inflation could be 8.5% by the end of the year, but I wouldn't be surprised to see double digits. We're already at the highest level it's been for 30 years. So it really is looking like back to the 1970s as far as inflation goes. Now, pretty much the only tool that the government has for tackling inflation is, of course, interest rates. That's the only lever it can pull in the economy, and what they tend to do is push them up a little bit. Now, the problem is that inflation has risen because of the pure money printing and massive spending, eat out and help out, and all that stuff that went on during the COVID times. Now, that had already set the track, the path for this inflationary upswing that we're getting now. The Ukraine crisis has just added to it because of the effect on energy prices. Energy and also food is likely to go up. There's a report today saying chickens are going to be up 30%. The other thing that's significantly changed, of course, since pre-COVID time is the government borrowing. The government have borrowed masses of money to pay for COVID relief. It stands at more than £2 trillion. It's nearly 100% now of our GDP. It's far higher than it's ever been as a percentage of GDP. What does all this mean? Well, high inflation means that the government have got to use that lever to control it, to try to bring it under control. Remember, it's 6.5%, but the target rate for inflation in the UK is 2%. So they've got to move interest rates up a little bit. The only problem with that, of course, is you move interest up a little bit, and it's a lot more expensive for all of us to service the debt we've got, but it's also a lot more expensive for the government to service its debt. Remember, they borrowed a huge amount of money during the COVID crisis. Government debt is now £2 trillion. That is going to cost a lot more to service. Already there's a report out last month saying that the servicing the national debt, the interest payments are now higher than ever. So yes, rates will go up, but there's some big issues to do with how much rates can go up. And the recovery that we've had coming out of COVID is fragile, to say the least. There's another danger that the Bank of England is worried about, which is exactly what we had in the 1970s, which is the spectre of stagflation. Stagflation is when you have inflation, but you have stagnant growth. And with the current sort of economic circumstances, that is a real risk of increasing interest rates too much. I think there's a hope that the Ukraine crisis subsides, and therefore that brings down the commodity prices, the energy prices, and also the food prices that people are kind of planning for right now. So how does all this affect property prices, and what should you guys be thinking about as property investors? Remember to smash that like button, show your appreciation and love for this video. Also, if you're not a subscriber, make sure you subscribe and hit the bell icon so you're notified when we put out further updates. Now, there's quite a bit that you guys need to think about if you're a property investor and take some action. and amend your plans to take into account all this news around us. The first thing you should think about is if you're looking at remortgaging or you're purchasing a property, my recommendation would be to lock into fixed rates, and I'd be looking to fix my mortgage interest rates at around 5 years. 5-year money is still priced quite well at the moment, but that's likely to change as time goes on. We'll get back to the video in just a moment. What is the most exciting opportunity in property right now? And that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for, and how to exploit these opportunities. And that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training, and I'll leave you to enjoy the rest of the video. So what is all this going to do with property prices in the UK? Well, we all know, and I've done videos on this, that property prices have been on a massive upward curve, if you like, pretty much for the last couple of years, pretty solidly. Month on month, we're seeing increases, and good increases in prices. Now, some people are wondering whether increases in mortgage rates means that you're going to have a dip in property prices. Now, I don't think that will happen, and here's why. Now, in the past, interest rates have gone up, obviously because of inflation, but it's also gone up because money has been in short supply. It needs to be rationed, and one of the ways to ration it is to put up the price of it. Now, when money itself is in short supply, you tend to see a corresponding fall in prices. If people can't get hold of a mortgage, I mean, most properties are bought with a mortgage. If people can't get hold of a mortgage, then obviously that's going to affect affordability, and that's going to mean that property prices cannot rise because people can't afford them, so they'll fall a little bit. We don't have that problem this time around. There's more than enough money in the system. What will be a problem is affordability. If mortgage rates are going to go up, then when the bank assesses you for a mortgage, they're going to look at whether you can afford the repayments, and because of the increased mortgage rates, you may not be able to do so. So this is where the bank conveniently changes the rule book. Bank of England is recommending that they withdraw, they basically revoke some of the affordability tests. Now, these affordability tests were put in place after the last financial crisis, 2008, 2009, and they were brought in because they wanted to make sure that banks had financial stability and they weren't over-lending to people, to borrowers who could necessarily fall into trouble, because if enough borrowers fall into trouble, of course, the bank then falls into trouble. Now, bank stability is an issue that's largely been addressed. Our banks in the UK are much, much more solid than they ever were pre-2009, and that's why the Bank of England is looking at changing the rule book, changing the affordability criteria. Now, one of the key rules they're thinking of changing is this. If you get a fixed rate, if you apply for a fixed rate mortgage, let's say it's a 3-year loan, 3-year fixed rate mortgage. Now, when the bank does an affordability check on you, they won't look at the interest rate you're paying from day one on the 3-year fixed rate mortgage. What they'll look at is the rate you'll be paying at the end of the 3-year fixed term, when the mortgage reverts back to the pay rate, the standard variable rate, and they'll stress test it based on that. What they're proposing to do is not do that at all. They will stress test mortgage affordability based on the actual pay rate under a fixed rate mortgage. So the long and short of it is that, yes, interest rates are going up, but the way the Bank of England is going to stipulate that individual banks run their affordability checks on borrowers will be less stringent. And that will mean that even though interest rates are going up a little bit, affordability of loan sizes will not be impacted too much. Now, that will mean that, coupled with the fact that there's still a massive supply-demand imbalance in the UK with housing, that will mean that the trajectory for sort of house prices shouldn't change in the medium term, but in the short term will certainly dampen a little bit. What I mean by that is the rate of growth will fall, but the trajectory will still be up. So we've just had Rishi Sunak's spring statement, where he hasn't really said anything that affects us as property investors. Of course, you're saving 5p a litre on fuel, which is good news if you looking to tank up your Ferrari, Lambo or Porsche. He's announced 0% VAT on certain green improvements to homes, which may help if you are upgrading substandard homes to meet with EPC Grade C performance requirements in the next few years. He's put up the national insurance threshold to align with income tax rates. So basically on the first £12,500 of income, there's no income tax or national insurance. But I think that's been sneakily offset by the fact that national insurance rates are going up anyway by 1.25% in the coming months. One bit of interesting news for property people is that, of course, a couple of budgets ago we had the super deduction, 130% capital allowances for certain types of investments, which also apply to certain types of property as well. He has suggested that in the autumn budget there is going to be some incentives for capital investment by businesses, and there will be something in there for property people. But he's just trailed it, but that's coming up in the autumn budget. So what should you do if you have a little bit of cash in the bank? Well, if you've got cash in the bank, you've got a real problem right now. Interest rates have gone up. But if you look at the interest rates going up, you've got interest rates on loans going up, but the interest rates on savings haven't gone up by anywhere near at the same amount as the interest rates on loans have risen. So basically, if you've got 50 quid in the bank, it's getting worth less and less each time. The buying power of that 50 quid is being eroded month by month because the interest rate you're earning is nowhere near the inflation rate. So remember what I said early on in the video. The Bank of England itself is predicting 8.5% inflation by the year end. I think it'll be double digit. So you've got to do something today to make sure you hedge against that 10% inflation that will eat away your savings or cash pot. Whenever we have times and periods of inflation, what we tend to find is that the best medium-term hedge against that is real estate investing. Now, when you invest in real estate using the BRRRR method, I've done a full video of this, I'll put a link up there. When you use the BRRRR method, you certainly ensure that basically you not just hedge against inflation, but you beat it. In times like this, inflation is like a bear chasing you. You don't want to let it catch up with you. You want to outrun it. And the way to do that is by investing in real estate. Now, in the short term, the growth rate will fall. It'll still grow in value, but the growth rate will fall. And you'll find that the rate of growth will be under inflation. But what tends to happen is that once the inflationary cycle kind of normalizes a little bit, people look around and suddenly realize that real estate is comparatively cheap. The cost of everything else has risen, but real estate hasn't risen as much. So it suddenly looks great value. And that's when it starts to shoot. So that's why I say I would expect real estate to kind of shoot up and catch up in the medium term. In the short term, it certainly won't fall. Growth will slow. But in the medium term, it's your best fire bet for hedging against this current inflationary cycle. That's all for this video. Tell me what you guys think. I'd love to know what you think in the comments below. Make sure you subscribe and hit the bell icon and stay tuned for more updates. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.